Hello, and thanks for watching another quick tutorial today by Low VA Rates. This is Eric, and today we are going to talk about why you were given a higher interest rate, okay, when you bought a home with your VA loan or possibly did a recent cash out refinance with a VA mortgage to pay off some debt or get some cash out of your home. We are seeing more and more people lately with interest rates that are substantially higher than what they could have gotten, and there's some confusion as to why the lender who did their loan would have given them such a high rate. So we're going to go over that today. Number one, you have to understand that VA loans are 100% financing. What that means is when you purchase a property, you don't have to make a down payment. No 20% down, no 10% down. There is zero money that must be put down from a veteran when buying a home, okay? So this is a huge benefit of the VA loan. It's probably, in my opinion, the single largest benefit, though there are many, as to why someone would want to get or use a VA mortgage when buying their home. Number two, for some of us, for some of you, that means that there's no money down also translates to no money out of pocket. This is not necessarily the case. Just because a loan is no money down does not mean that it does not require money out of pocket. Now, it can be structured as such, and we're going to get into that here on some of these next slides. So here's a question. Are VA loans free? Okay, that'd be great if they were, but I'm here to tell you, if you ever took an economics class in high school or college, one of the main things that I remember is this whole concept of there is no such thing as a free lunch. Okay, there's not. Here's a real quick tutorial on what that means. If somebody says, hey, let's go to lunch today, it's on me, it's free, one person might say, well, there's no reason to ever not go to lunch with somebody if they're paying, because who doesn't want a free lunch? Well, keep in mind there are opportunity costs in all of our decisions. So what this means from an economic standpoint is if you have to leave work for an hour to go and get free lunch from your friend, think of you're off the clock. You're not making money. Or if you don't work on the clock, but you run a business or you sell something for a living, while not working and while at lunch, there is some sort of cost associated with your time. That is the most simple explanation of this concept of there is no such thing as a free lunch. Well, it's the same thing with VA loans. VA loans are not free. Every single VA loan ever done has closing costs to some extent. The question is, who ends up paying for those costs? And we're going to get into that here in a moment. But think about it. The Department of Veterans Affairs, they have a VA funding fee. They are getting paid on every single VA loan, unless, of course, you fall under the disabled veteran situation. Then the VA actually waives their fees, and that would be an exception there. But even for disabled veterans and for anybody else getting a VA loan, there's a title company involved. I can promise you they're not working for free. Your county recorder, the same way the IRS requires us to pay taxes, so does each county, each city. You got to pay real estate taxes. An appraiser is going to have to get paid on every single VA cash out or VA purchase. And yes, even low VA rates or even whatever lender you went through, we also are in business to make money. So VA loans are not free. So let's get into that. How does this all work then? Well, number one, as I mentioned, the lender and everyone else we just listed off is going to get paid in one of two ways. It's very, very simple. Either one, they're going to charge you, the veteran, up front with closing costs. Okay, and there's all sorts of trainings on our YouTube page, under Low VA Rates' YouTube page, to go into closing costs. Or they're going to give the veteran a higher rate, and then that is going to cover all of the veteran's closing costs. Okay, the higher rate basically means the bank or the lender, the institution doing the VA loan, is going to make more money behind the scenes or after the fact. And that's a much more detailed explanation, can be given at another time. But it's pretty simple the way the math works. Now, on purchases or cash outs, most veterans prefer no money out of pocket. So they end up getting a higher interest rate. Okay, that's how it works. You're working with a realtor. You don't want to put any money down. Either your realtor, if they're good, is going to negotiate with the seller of the home to cover some of your costs so you can get a lower rate, or your mortgage lender is going to give you a higher interest rate than they would someone willing to pay closing costs. Now, on a purchase, you cannot borrow more than the sales price of the home, so all of those closing costs do have to come out of your pocket. On a cash out refinance, which a lot of people are doing right now, it's the same thing. You cannot borrow more than what your home is worth. Therefore, if you pay closing costs, that shrinks or diminishes the amount of cash you have access to pay off credit cards or to do home improvements. So on both the purchase and the refinance, most veterans take a higher interest rate so they can minimize the amount of cash they have to bring to the table. We're going to keep talking a little bit about how this all works. Again, higher rate equals lower costs to no costs at closing or up front. That's why you likely were given a higher interest rate on a purchase than what might be being offered to you today on a streamline refinance. A lower interest rate means higher costs up front. Origination fees, points to buy down that lower rate. The lower the rate you choose, the higher your costs are going to be, which on a purchase and cash out would mean money out of pocket. Here's an example. On a $225,000 mortgage at 4.5% with no closing costs, so you're just going to borrow $225,000, you will end up paying $410,000 over the life of the loan. Almost twice of what you borrowed. That's interest, folks. That's how it works. The longer you're in that mortgage, the more you're going to end up paying in interest over time. Same thing. Let's say you do a $225,000 loan to purchase a property, but you've got some cash in the bank, or the seller, if structured correctly, pays your closing costs, and you're able to get a 3.25%. Well, you're going to pay $352,000 over the life of your loan. Notice the difference between these two. Substantial difference, okay? That's the power of interest. You're going to spend about $58,000 more in interest over the life of the loan by taking a higher interest rate. So let's look at the streamline refinance, or the IRRRL. What I love about this product is it keeps all of us in line. At least it should. Kind of like a referee. Keeps everyone playing fairly. Think about it. On an IRRRL, you can now take all these closing costs that on a purchase or a cash out have to come out of your pocket, and you do not have to bring them out of pocket. You can add them into the balance of your loan. You can now borrow more than what your home is worth under the IRRRL. There are certain guidelines. You can't just tack on unlimited amounts of closing costs. The VA has some rules to keep lenders and borrowers in check. But what's so great about this IRRRL program, it acts kind of as an equilibrium. Okay, if it were not for the IRRRL or streamline, I'm going to go out on a ledge here and tell you VA lenders would probably be giving veterans even higher interest rates at the time of purchase or cash out, because they would know there is not a real easy way for borrowers to lower that interest rate. See, they want to keep you, these mortgage companies, low VA rates, for example, we want to keep you as a customer as long as we possibly can. So there's this balancing act between a competitive rate and way too high of a rate. And what we have found, I was speaking via email with someone this morning who was just given a 4.5% interest rate recently. I'm telling you, in my opinion, that is someone who got taken advantage of. Because interest rates, you do not need to be given a 4.5% rate. You could have gotten a lower rate than that with no closing costs in the last 4 to 5 months, even any time last year with low VA rates and many others. For whatever reason, I'm not aware of all the details, this particular consumer was given a 4.5% rate. Now they're considering refinancing. Well, they should. They should get out of that rate and speak with a knowledgeable VA loan officer and do a streamline and get out of that rate before it's too late, before rates go up and you can't do it. It helps keep your lender in check. Okay, that's the whole point. You should use the VA IRRRL to your advantage. Now let's talk about that. When is the best time to do an IRRRL or a streamline? Now, number one, when current rates today are lower than the rate you have. For example, I was speaking about this consumer, this veteran who's at 4.5%. We have rates much lower than that today. We have rates lower than that today that have zero closing costs. And one might say, well, then why didn't they get a lower rate with zero closing costs when they just got their VA loan? I don't know. They just didn't. But we could lower somebody from 4.5 today on an IRRRL take them down lower than that and not charge them any closing costs. Or we can charge closing costs as I have explained, and they can get an even lower interest rate. Now, in my opinion also, the sooner you refinance after getting a new VA loan, the better, if you're lowering your rate and saving money, because at this point you have not paid years and years off of your balance. The longer someone's in their loan and the more and more years that have gone on, it's more difficult to emotionally justify refinancing because you, generally speaking, go back to a 30-year mortgage. So assume you had paid on your loan for 5 years and then someone offers you a streamline. Certainly many people do that. You could refinance into a streamline loan at 25-year term. But if you've only been in your mortgage for 4, 5, 6 months, why not refinance right away if you can get a lower interest rate? Now, another time to do it is when you could use monthly savings. Life changes. People lose their jobs. People have children, college. If there's an event in your life that another $100, $200, $300 a month could possibly change your financial situation for the better, go ahead and look into a streamline refinance. We have some people that maybe aren't saving tons of money on the interest rate because they were given a somewhat good interest rate when they got their last loan, but with the streamline refinance accompanied by an energy efficient mortgage, which one of our VA loan officers here at Low VA Rates could go over with you, you can also upgrade or improve the energy efficiency of your mortgage, of your home through a streamline coupled with an EEM or energy efficient mortgage. So maybe you're not saving as much on your interest rate, though we would have to save you something. That's part of the VA IRRRL program. We could save you lots of money by giving you a more efficient furnace or helping you put solar panels on your house. There's lots of interesting things you can do. So I thank you for watching today. This is just an introduction. Please give us a call and we can look at your particular situation. But if you have an interest rate that is a half a point or even a point or more higher than what someone is offering you on a VA IRRRL or streamline today, please look into it. Discuss this with a VA expert here at Low VA Rates or anywhere else that you have trust. Get with them and look at your options. Thank you.